Thanks for listening to Mike Douglas, Michigan's retirement coach.
So we've made it past the April 15th deadline, April 15th tax deadline. I think the collective sigh of relief around the country for accountants is one that's very audible. Is it something for you, Mike, where it's not that big of a deal this time of year for you? Because there's always tax talk happening at Life Plan Financial Design?
Well, it's both, because we do tax returns for clients. And
Got
there is that busyness of it. But I think the beauty of an integration when you have your financial advisor doing your tax returns is that you aren't waiting to get all your documents to then get them over to somebody to then get someone to put them in we get the documents. So the investment reports, they come straight to us and we get those uploaded. So when you bring in your stuff, we're already halfway done.
Okay.
So for us, most of our clients are all knocked out with their taxes well before April 1st. So for example, on April 15th and April 14th, we were doing very, very little as it relates to taxes because it was already done. We're just going down our checklist and auditing and making sure everything's good to go.
Yeah.
But it's a big part of our year-round discussions is we start planning for Roth conversions because that has to be done before the end of the year. And then we start looking at when the market's down, are we doing tax harvesting? There's a lot of stuff involving taxes that we kind of are constantly dealing with year-round. But there is definitely the February, March busyness of doing a lot of tax returns.
Let's focus in, let's hone in on the Roth conversion conversation. The thing about Roth conversions, they've obviously been a huge topic of conversation over the last several years. However, sometimes it can be a tough sell because to do a Roth conversion, it very often means paying taxes now instead of later. And people don't like that. It's about the long game when it comes to Roth conversions, but it can be a tough initial pill to swallow. However, IRA expert Ed Slott says recent tax law changes may have quietly created one of the best windows in years to make the move of Roth conversion work in your favor. So Ed Slott says new rules around inherited IRAs, required minimum distributions, and today's unusually low tax rates are reshaping the Roth conversion conversation. So the question for you is, who should be looking right now, perhaps even the hardest at Roth conversions? And how could delaying actually make the tax bill worse later on?
Well, I think that Roth conversion is a discussion that everybody should be talking about. And there are certain windows of sweet spots where it makes more sense than others. But I did have a client who just came in recently, early 60s. And his big thing is, why should I voluntarily pay taxes?
Right.
That's a lot of people's comment about Roth conversion. Why am I choosing to pay tax but I don't have to? And that's fair. But when we projected his future, we saw very large required minimum distributions, higher tax brackets, and a big tax burden later on for him and his kids, especially with the new 10-year inheritance rule. So when we started looking at it, not from the perspective of just this year, but over the next 20 to 30 years, how much you're scheduled to pay in taxes, and then what the tax burden will be on your estate or your kids when it passes on to them, we start looking at that cumulative effect of taxes and realizing sometimes it makes sense to pay now so you can save way more later or keep way more later. Because remember, the government's going to make you pay taxes on a lot of this money that you've never taxed. So for him, when we went through and we said, Bill, I understand your thought process, why you are against paying taxes right now. However, you're scheduled to pay, I believe with him, it was right around $800,000 in taxes over the next 20 to 30 years. Not because he even wanted the money, but because when the government made him start taking money out of his accounts, it was going to just keep running up and increasing, and the tax bill was substantial. And then when it got to his kids, over 10 years, they had to pay taxes on all of his IRAs. So there was a lot involved.
Yeah.
And we realized that if we did some aggressive tax strategies, we could get that number down to about $350,000. And so again, we couldn't get rid of all taxes, but we could cut it from $800,000 to $350,000. And he said, all right,
that's a big amount.
Now I'm listening.
Yeah, right.
Yeah. And so we started doing small Roth conversions over time, not all at once. But again, it was a strategy. And now we've lowered his future taxes, reduced his RMDs. And actually for him, he's on pace right now. I believe we'll make it so he never has to take a required minimum distribution. As long as we stay on course. You know, life happens and sometimes we can't do Roth conversions because you have to replace the roof or you have to do this, that, whatever. But he's on pace right now that we'll have all of his IRAs converted by about age 71 or 72. Yeah. So by the time it hits for him to take them out, he won't have to take any money out of his accounts and he can choose when to take money out and when not to.
Okay.
So that's a really nice thing. And then when he does take money out of his accounts, it'll be tax free to him.
Right.
And then if taxes go way up in the future, he won't be subject to that. So again, it's a beautiful thing when you can proactively deal with taxes, not reactively deal with them.
Mm-hmm.
We don't want to be surprised by taxes. We want to get the jump on them. And that's what good proactive tax planning can do. Like I mentioned, when your financial planning and your tax planning are done in-house, it really gives you an edge. It's a little bit of it's not a cheat code, but it really is like I got, my team's really playing together. And that's a beautiful thing. And most people say, well, I don't have that. I got someone who does my investments. I got my estate planning guy. I got my tax guy, and they're all separate, all doing their own thing. And that's just not how we do business here at LifePlan. Everybody is on the same page because we all work in the same house. So that's a different model. Proactive tax planning, choosing to pay. And for Bill, again, just saving $450,000 in taxes over his life, that was worth the discussion. He came to us through a conversation, a referral from a friend.
Yeah.
We had helped his friend with his business, with their taxes, and he said, you got to talk to Bill. So then Bill comes in and we walk through it. That's how we help people. We hear your situation, hear your story. Your situation, Heather, your and my situation is different, right? And it's much different than Bill and his friend who brought him in and all the people who are listening right now. If you want a personalized tax strategy that's mapped out for you and your family, that tells you how much you're scheduled to pay over the next 20, 30 years and lets you reduce it, then give us a call. We can help you work that out, and we will build a tax strategy for you. 616-512-2127, or you can reach out to us at michigansretirementcoach.com and schedule a time for us to get together, have a conversation, and understand your situation and map out some things. Who should be looking at this? People in their 60s before your RMDs begin, that's kind of a sweet spot. If that's you, you should be looking at this pretty heavily. Those with large pre-tax IRA and 401k accounts, and also anyone planning to leave money to their children or heirs. I mean, these are the biggest tax liabilities. Big 401ks, they're going to make you take it out with RMDs. Then they're going to tax it like crazy when your kids inherit it. So if you have kids you want to leave money to, large portions, or you're in your 60s, it's a great time to do it. Waiting can cost you. RMDs later will push you into higher tax brackets. And I think the brackets will be quite a bit higher in the future than what they are today.
Right.
So just like when milk goes on sale, I buy extra and put it in the fridge in our garage because the kids are going to drink it. It's not if they drink it, they're going to drink it. So when milk's on sale, I buy extra and throw it in the fridge in our garage. Taxes for most people are on sale and you can stock up. RMDs later will push your tax brackets higher, potentially your Medicare premiums higher. Your heirs, your beneficiaries, if they inherit $1 million of pre-tax IRA, they have to pay taxes on that over 10 years, completely taxed within 10 years. So that's going to be a big tax burden to them. And today's tax rates are probably, I'd say 99% certain, are lower than they'll ever be the rest of my life.
Okay.
I can't see them going down.
Okay.
There's 39 trillion reasons to think it's going to go up. So I think that they'll be higher in the future. And so you might as well settle up with taxes now. The big thing is you're going to pay taxes on this money. It's just a question of when and how much. How we help people is we map out multi-year Roth conversion strategies. We keep you within the appropriate tax brackets, and we coordinate this with your Social Security, your Medicare, and your income planning to make sure you're not overpaying and not over contributing to the IRS. Not every tax you pay comes back in a refund if you overpay. Some taxes are just gone. You pay into it and it'll never come back. But if we get good tax strategies, good capital gain strategies, good income strategies, those things all work together and coordinate to make sure that you are built the right way for retirement. If you've built most of your savings in pre-tax accounts, think like a 401k or a 403b or 457, or even the old 401ks you've rolled over to an IRA, this could be a limited window to take control over your future taxes. Let's take a look at whether Roth conversion makes sense for you, because the goal isn't just to grow your money, it's to keep more of it. If you want a tax strategy that's made for you, that's made for your family, not for the IRS and not for the financial industry, but it's built around you and what's best for you, give us a call, 616-512-2127, or reach out to us at michigansretirementcoach.com. And what's going to happen is when you call in, someone's going to get you on my calendar. You're going to call and talk to somebody. They're going to say, all right, let's get you on the calendar to talk to Mike for 30 minutes. We'll have a phone call. We'll talk over it. I'm going to hear your situation. And from there, I'm going to either answer your questions, maybe set up a time for us to get together and talk more in detail, or just say, hey, you're on the right path and I understand where you're coming from and you're in a good spot. Either way, you walk out of that conversation feeling better about where you're going. So give us a call, 512-2127.
Want to remind people also that as you're listening, again, Roth and Roth conversions have been such a buzz phrases in the financial and retirement planning industry for the past several years, but they don't work for everyone. And if they do work for you and your plan, there is strategy. There is specific math that needs to be done based on your plan, your savings, your age, your goals. It's an intricate process. It can be very helpful, but it's very important that you know what you're doing and that you don't just start converting money without understanding how it all impacts your overall plan. So this is what Mike and his team can help you figure out. If you just have questions about how a Roth may or may not work for you, let's begin that conversation. Again, the number to dial 616-512-2127 to set a time on Mike's calendar for this initial phone conversation. No fees, no obligation, just a space where you can ask some questions. He'll give you some answers and help you understand how he and his team might be able to help. 616-512-2127. All right. Getting close to retirement. One of the biggest hurdles for people, it's not having saved enough money, Mike. It's trusting that they can actually use what they have saved in retirement.
Yeah.
Yeah, right. Yep. You know, financial author Bonnie Treichel was telling Morningstar how she compares it to the layers of an income cake. This is Bonnie Treichel.
Helping people think about, at least I've got these couple of layers of my cake that create some certainty for me. A little bit of Social Security, a little bit of that annuity component in a retirement plan or otherwise. It does provide some safety and security to be able to feel like, okay, at least I know I'm going to have this much and I'm going to be okay. And it creates that permission to spend. And I think that can really be useful for folks when they start to think about, it's going to be okay to retire. It's going to be okay to spend a little bit.
Okay, so she brought up a few angles. You want to focus in on the annuity conversation right now. Let's play a little game. Play some true or false.
Is this Mythbusters Annuity Edition?
Come on, let's have a good time.
I like it.
Statement number 1. All annuities are created equal. True or false?
False.
Okay.
100% false.
Okay.
So
wait, I'm not done. I'm not done. Rule number 2.
I'm ready to go.
You should definitely put all of your money in an annuity. True or false?
False.
Because there are people out there, Mike. There are bad annuities out there, and there are people out there that will tell you to put all of your money into one. Let's break up some of the confusion about what annuities are, how they can work in a plan. But what do you want people to know as far as they are just a tool and one piece of the puzzle, one piece of the cake?
Yeah. I think what's important to remember is that annuity is no different than the word stock, bond, mutual fund, life insurance. Like it's an investment.
Right.
And not every investment is suitable or appropriate from a fiduciary standpoint to everybody.
Right.
You have to understand the purpose of the tool, right? So it's well documented. We've talked about this quite a bit, but I am not handy. I can't fix anything at our house. Like, I'm really bad at fixing things. It's impressive and a little bit emasculating. But when we moved into our house several years ago, we bought a house in 2017, and the guy was very handy. He had all these tools in the garage, and he reached out to us and said, and now again, we're moving into a house. We have to do some fixing up. Mm-hmm. And he said, if you'd like, I'll sell you all these tools. I don't want them anymore. I'll sell them all to you for $200. Tool chest, tools, all these things. And I'm like, that's incredible. Yeah, we'll buy it. I bought it. And I literally said to Kimberly, I'm going to learn this stuff, and I'm about to become a master craftsman.
Okay.
Just watch me learn. Right.
Okay.
Heather, there are still tools in there. I don't know what they are. I'm like, I don't know why there's so many different chisels. I don't know why there's so many different Allen wrenches. I thought they were one size fits all. I don't know how, like, why do we need 50 different screwdrivers? Like, there's so many things.
Yeah.
And yet he said tools. And I'm like, yeah, tools. Okay. Yeah, I'll take your tools. And he's got a bunch of different hammers. I don't know why these hammers have different faces on them, but they do. And the reality is the term tool is a very broad term with a whole lot of different purposes. Annuities is a very broad term with a whole lot of different purposes. I had a client who he really had done a great job at saving money. He came in well over $1 million. But he was barely willing to spend anything. Because this is the joke we make. I say a zebra doesn't change its stripes just because it retired, which is a mixed metaphor. But the idea is that if you're a saver your whole life and then you retire, you don't become a spender. You're still a saver. You still are All right. So I'm not going to say cheap because but
Frugal.
you're still frugal.
Yeah.
You're still cost conscious,
Yeah,
right?
of course.
Some people are flat out cheap too. Like we can call
Right.
that what it is
Right.
too. But the reality is if you're a great saver, you spent your life saying no because we have to save. We won't do this because we have to save, or we can only do it this way. We can only do the trip this way because it can't go over $3,000 because we have to save money. Well, then you retire. And now we're on kind of the back nine of our lifetime golf course.
Mm-hmm.
And we're playing out the round and we're saying, hey, should I be spending this money? I'm just uncomfortable spending the money. What if I run out? I'm afraid the decisions I make today will hurt me 20 years from now.
Mm-hmm.
And that's a very fair, valid complaint. So when we build out a retirement plan, we say, how much income do you want every single month? And not just like what keeps your lights on and keeps DTE from shutting off your electricity, but like what actually gives you the life you want. And if you say, if I have $6,000 a month, I'll never spend that much. And that's more than enough. All right. Well, then we look at what you have. What are your Social Security's total? $4,000 a month. Okay. Do you have a pension? I don't have a pension. All right. So we need $2,000 a month. And I see it time and time again where I tell someone, hey, you have $1 million and you only need, $2,000 a month. That's gross about $30,000 a year. We're going to take out 3% and pull it and pay for your lifestyle. And they are uncomfortable with the word $30,000.
Sure.
They can't wrap their mind around, you're taking $30,000 out of my investments every year.
Mm-hmm.
Yeah, every year to pay you the income you want. What if the market goes down? What if? And they go down this whole list of concerns.
Mm-hmm.
And because they're a saver and because they've always been trying to keep it together.
Mm-hmm.
So for a lot of times, those people, we say, let's take a portion of your money, put it into something like an indexed annuity. And rather than needing $1 million to get 30 grand a year, a lot of times we can take like $300,000 or $400,000, invest it, and it'll pay out that same income. Now the rest of your money, the $600,000 or $700,000 that's outside of it, it can grow, it can be free, it can do whatever you want it to do, and yet your paycheck is covered every single month.
Yeah.
So rather than needing the whole pot to do well for me to be okay spending, we set it up in a way where the systematic payment comes to you every single month. That annuity cuts a check as long as you or your spouse is alive. Guaranteed, regardless of the account balance, regardless of the stock market, regardless of anything around you. There is a comfort that comes from being able to spend money with no risk. And that's what happened for our client. When he came in, he had that over $1 million and he's afraid to spend. He said, I'm afraid if I start, I won't know when to stop. And I'm going to become this bad habit person. Right. So we built him a layered income, Social Security, and then this guaranteed income stream. And then the other $600,000 to $700,000, it becomes flexible money. Hey, I got a big trip coming up. I got a vacation. I got this. I want to remodel the kitchen. That's where you pull that from. A few months later, he comes in and says, now I know what I can spend and I'm starting to enjoy it.
Right.
Which is a whole different lifestyle.
Yeah.
Because he realized every month, whether he spent it or not, another $2,000 net was showing up in his bank account. And he might as well spend it because next month, Mike's sending me another $2,000 a month, right?
Yep.
And it's just happening. So where do annuities fit? They're not all or nothing. They are just one layer in that income cake. It's used to cover your essential expenses, not everything in life,
right.
But it covers your lifestyle and it helps create predictable income that you can't outlive. The key thing here is that annuities aren't the whole plan. They're a piece that can make the rest of the plan work better. If my income's covered, my stress is down, and the market can be my friend, not my enemy. I'm not afraid of a dip in the market to change my lifestyle. Most people get these bad information, or they're sold an annuity by someone who's just lying and selling to them, or they're lied to and said that there's no such thing as a good annuity. I really think it's just like a tool in the toolbox. If you know how to use it the right way and you put it in the hands of a master craftsman, it can do beautiful things and build something amazing. If given to the wrong person, it'll sit in the toolbox unused or it will hurt you. So don't let that happen. Work with someone who knows what they're doing and work with someone who understands you and your family and builds plans right for you. That's what we do at Life Plan, building an income cake, an income strategy that's meant for you, not for the advisor. It's built to give you the life you want. Give us a call, 616-512-2127, and we will make sure that if you have an annuity or if you need an annuity, it's done the right way for you. 616-512-2127.
There is a Reddit thread going around talking about the things our younger selves survived that would emotionally damage kids today. I think about things that I'm so grateful. You know, remember, did you take swing dance class? Was it Foursquare? Foursquare. What's the country line dancing? Foursquare. They never didn't teach that in school?
No. I went to a suburb school.
Okay.
No, we didn't do that.
City school.
Yeah.
I mean, just the opportunity to have gone through those traumatic 12-year-old, 13-year-old, 14-year-old years without cell phones. I will give kids today that credit. Like today, everything gets recorded. God bless them. Okay, so some of the things that are on this list that kids today would not survive. Dodgeball in gym class was the number one answer. Are they not playing dodgeball anymore? Are kids not getting pummeled by the big red rubber ball?
Not the big red rubber ball. Schools went to these like softer,
Nerf type,
much harder to throw. It's a Nerf ball. It's safer for sure.
Okay.
Less broken glasses.
Got it.
Also less life lessons learned.
Something else kids wouldn't survive today, writing out first drafts of reports by hand. Do you remember hand cramping when you used to have to write everything by hand and you would have to do a first draft and then you have to do the second, the final draft was in calligraphy?
Yeah, front and back of a page, like you're using a notebook to the fullest. Mm-hmm. Those are things that they don't do anymore.
Mm-hmm. Nothing was on demand. You had to plan to be home just in time to watch your favorite TV show. And if you missed it, you missed it. That was just life. What a tough world these kids have these days. Something that we can all relate to, though, as adults is the autosave feature. Remember, if your computer would crash and you were in the middle of a document that you hadn't saved and there was no autosave, that was it. Your work was gone. I think usually everybody's got a story of that when that happened to them that one time and how you become crazy, manic, a saver. I'm still to this day, I keep checking my file to make sure the autosave is working.
Oh, yeah. And if you ever do anything that doesn't do it, now you're very paranoid about it. Like, I love that all of our software auto saves, like when I'm building plans for clients or we're going through and doing tax analysis, like everything auto saves. And then you get one program that doesn't, and you're just on high alert the whole time.
Alert. So thinking about our retirement savings and how things can traumatize us, whether or not you're paying attention to it, your 401k plan, it's got fees in it. And tragically, a lot of times the fees are hidden. You have no idea the money that's going out. And so for some people, they might discover many years into the amount of money they've lost in 401k hidden fees. And again, it's that PTSD feeling of this happened to me then. How can I prevent it from happening to me now? Is there a way to help autosave or undo past errors or things of that nature when it comes to our lifetime of savings?
There's some things that we can't fix from the past, but we can avoid in the future. Yeah. We had a client who came in, great saver, disciplined, did everything right, very intentional with the decisions that he was making. And he kept saying, I just want to make sure I'm on track. That's why he came in. I just want to make sure I'm on track. I don't really want to change anything. I just want to see where I'm at. And we did what we call our portfolio x-ray or a receipt analysis. We just take every investment you have, we put it into our software, and it tells us the exact fees you're paying for your investments. And they're hard to find if you're just trying to look regular.
Yeah.
But we're looking for fees, expenses, hidden costs. So what we found really, really shocked him. Between his fund expenses and advisor layers, he was paying close to 2% annually for his investments. And when I asked him, I said, what do you pay for your portfolio? He said about 1%, which I knew that's what he's paying the advisor. On top of that, he has to pay also for the funds inside of it. That's like saying I order from Instacart or Shipped and they deliver groceries to me. And I say, how much does your groceries cost? And you only state the delivery fee, right? Like if someone from is delivering you groceries from Meijer, whether it's Instacart, Shipped, or whatever, and you say, well, the delivery fee was $10. Your groceries didn't cost you $10. That's how much it costs for someone to walk through the store, grab the stuff for you, put it in a cart, run it through the checkout lane, and then deliver it to your house. Still a great deal, in my opinion.
Yeah.
But that's not the cost of groceries. You can't pay a $250 grocery bill and say it only cost me $10 for groceries because that's what the delivery fee was. The advisor fee is a delivery fee. It's someone who goes through, grabs the investments off the shelf, puts them into your investment cart, your IRAs, your Roth, and they choose them for you and put them together. That is the cost of a private shopper. It is not the cost of the groceries. Your investments oftentimes still have hidden costs in them, expense ratios, phantom capital gains. There's all these things that are built into the cost of mutual funds or ETFs or annuities or REITs. There's a cost associated with the investment. And that's where people get mistaken. And again, the same way where you wouldn't say the whole cost of your groceries was the cost of delivery, the whole cost of your investments isn't the cost of your advisor. It's also who's on the other end of that fund at Fidelity or Vanguard or Lord Abbett or wherever. So when we ran through, it was about a 2% total fee he was paying per year. And this is on top of his 1%, by the way. He was paying 1% to the advisor, and it was close to 2% in extra fees every single year.
So 3% total or an additional 1%?
3% total.
Oh, okay.
3% total. A lot of that was baked into a variable annuity. He had a variable annuity that had a 3.5% fee structure. And that was very expensive.
Yeah.
His investments had about an extra half to 1%. So between the two of those, it came out to be about 2% total in hidden fees.
Okay.
So over the course of your life, 20, 25, 30, 35 years, that's hundreds of thousands of dollars that are gone.
Yep.
And not only are they gone because you paid them, they're gone from what your portfolio balance could be. And his reaction was simple. I had no clue I was losing that I was paying it and I was losing out on the opportunity. That's the danger. It doesn't feel like a loss up front, but it really is. So where the hidden leaks come from, you have to know that there are expense ratios inside of mutual funds, layered advisory on or platform fees, old 401k sitting untouched. That's an opportunity cost. Variable annuities, high fee structures. There's a lot going on there. And a lot of people say, I don't know what my fees are. I know I'm paying someone to personal shop, but I didn't realize there was so much potential cost in my portfolio. How can I know? Well, we can run a receipt for you. We take all of your investments that it's in your current investment cart, which is your accounts. We run them through the software. And just like we did for him, we tell you where you're at. We give you the receipts back and you can see clear, plain as day, what you're sitting at. Because remember, he came in just to check and see, just making sure I'm on track. By the time we got through it, he said, I'm paying an extra 2% in fees. For him, that was over $20,000 a year in fees.
That he didn't have to be paying.
He didn't have to be paying. We were able to do the exact same goals.
Yeah.
Because after that, he said, well, what would you do? How could you reduce it?
Right.
So again, he was already paying over 10 grand a year for the advisor.
Yeah.
And then he's paying over 20 grand a year for the investments.
Right.
So he said, what if we could get the all-in cost down to about $12,000?
Yeah. Ideally.
Again, it's not cheap, but we just knocked off, a ton of fees. Here's not surprising. His portfolio did better when he stopped overpaying in fees, right? That's a great thing to have, especially when the market resets. Like if you have a pullback in the market, don't keep paying high fees. If this is you and you're out there saying, gosh, I have no clue what I'm paying in fees, that's okay. Most people don't, but now that you know, you can take action. You can do something to get it fixed. If you'd like us to run a receipt for you, to run a report to let you know exactly what you're paying in fees, I'm going to describe the process so you can understand what it looks like. Give us a call, 616-512-2127. You're going to talk to one of our team members. They're going to get you set up with the time to talk to me on the phone. I'm going to ask you some questions. We're going to set up a time to review your portfolio. We'll put it in the software. We'll give you a receipt, and you will know beyond a shadow of a doubt exactly what you're paying. Not everybody comes out like his accounts were. Some people come in and I run it and I say, hey, good news, your very low fee structure. Here's our recommendations, blah, blah, blah. Take it and do what you want with it. Or other people come in just like him, say, I'm just checking to make sure I'm on track. We reveal the information and they say, holy cow, I'm not okay with overpaying by $20,000 a year in fees. Please help me. And then we help them get it right. So again, that's what we do. If you'd like someone to run a receipt to give you that information, 616-512-2127, or reach out to us at michigansretirementcoach.com and we'll get that scheduled. And here's the thing. You worked your whole life to build this, and a piece of it may be slipping away without you even knowing it. And that's unfortunate because you're paying a fee to an advisor to do it. And that stinks. Big box firms, they typically just plug clients into pre-built models or proprietary funds with hidden costs that benefit the big box firm. They will have less focus on digging into every layer of cost, and they focus on managing assets more than protecting efficiency. That's what it's about. how we help, we run that portfolio x-ray, we identify every layer of cost, and we get you more of what you earned back in your pocket. Give us a call, 616-512-2127, and we can make sure that you know what you're paying so you don't overpay ever again.
Mike and his team, they're here to help guide you through this process, because at the end of the day, the goal is that you're going to retire one time, but Mike and his team, they're retiring every single day. We're helping folks do that. So they got a wealth of knowledge in their pocket that they're ready to share with you. MichigansRetirementCoach.com is our website where you can go to start the conversation with Mike and his team, or click on the links we got posted in the show notes.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit MichigansRetirementCoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.